This is a housing warning no one is talking about. Loan limits just jumped, credit barriers are gone, buyers are rushing back, and a 2026 housing surge is already in motion that no one's talking about. Now, what does this mean for you as a buyer and a seller? You'll want to hear this. You see, FHA just raised their loan limit to $541,000, but it gets a little bit higher than that, so go with me. $541,000, the Federal Housing Administration. Now, I'll explain to you here in just a second exactly what they do, but most importantly, they've raised that loan limit. That means that you can get an FHA loan with only 3.5% down. The seller can pay your closing costs on a home that you're buying, getting an FHA loan. And the credit credentials typically start at around 620 for a credit score, 2 years on the job. Now, it's important to know that that's great for not only buyers, but for home sellers, because if you're a homeowner looking to sell your property, that's putting more buyers to the market and more opportunity for your home to be sold. Now, a lot of people say, well, Wayne, I don't want my home to go FHA. And I ask, why not? Like, why? It's no different. And people say, well, the appraiser. No, it's not. Don't even worry about that. You want to make sure that your home is ready and available for anybody, FHA, VA, USDA, all of that stuff. You can sell your house to anybody, any kind of loan, but I wouldn't limit myself, because you're going to limit the buyers. And when you limit the buyers, you limit the money and the profit that you can make. Now, that $541,000 is not just set in stone, so to speak. 541 is actually the lower of the limit. Like, there's a limit and then there's a bigger limit. So for example, if you're in Boulder, Colorado, or maybe you're in Colorado Springs, or maybe you're in LA, for example, they're higher in areas. The FHA loan limit in those areas is 1.25. So $1,250,000, you can basically get an FHA loan. Seller can pay your closing cost. What's that run you? About $42,000, and you got a $1.2 million home. Now, don't get me wrong, I'm not trying to talk you into buying a house, but you have to understand that when you get these loans with FHA, and this is very important to listen to me, when you get these loans with FHA, you will have to pay private mortgage insurance. That's an insurance policy that the lender puts in place in case you default on the loan. It kind of covers them. Here's the difference. With a conventional loan, you can buy a house, you only need 5% down. FHA, you need 3.5% down. Both of those, if you don't put 20% down, you're going to have to pay private mortgage insurance. The difference in the two is, with conventional, that private mortgage insurance can be removed after you have 20% equity. In other words, you've paid your mortgage down, the home's gone up in value. Once you got 20% equity, you can call them, have it appraised, it'll be removed. With FHA, it stays on there forever. It's important to know that, because it used to be FHA says, you can get it taken off. No, that's no longer the case. If you have an FHA loan that's in place that you've gotten and purchased with FHA loan for the past several years, you cannot have that removed. The only way to get that removed is if you physically refinance the mortgage. Now, the reason why we're seeing such a surge to the market is basically homes have been pent up. Homeowners have not been selling their homes. That means less homes on the market. And at the same time, there's been less buyers. So you have to understand, for 2.5 years, starting April 2022, they started raising interest rates, and they nearly doubled those rates 7 months later, literally as of October 2022. So you have, for 2.5 years, people have not been selling, people have not been buying. So what happens now is you're going to have more people that are going to start putting their homes on the market, and we're seeing that already. Redfin did a study, and keep in mind, a lot of these numbers and people and businesses, they benefit by brokerages, some bad news, some good news. At the end of the day, it's hard to know who to believe. That's why I try to produce and put out as much information as possible. And for those who subscribe to my channel, thank you. I'm more than appreciative. My purpose is to learn something and master it and teach it. And as a result, I've been selling and brokering real estate for 30 years. I've helped thousands of people, and I just think it's important to let people know not only how to buy, how to sell, how to save money, how to make a profit, but the latest in the news and what's going on with the housing and everything about real estate. So yes, they are predicting a surge because they're seeing a 31% rise right now in mortgage applications. Mortgage applications are up. The Federal Reserve adjusted the rates a little bit, and everybody always says the Federal Reserve doesn't have anything to do with the mortgage rates. Well, they don't physically adjust the mortgage rates, but it does have a lot to do with treasury bills and bonds, all that, right? So the interest rate will come down, it will come up. You'll see that. Right now, we've seen them adjusted a couple of months ago. The rates came down. They just adjusted it recently. The rates haven't moved. They may or may not move. And they're also predicting next year to only have one rate cut. But here's what you have to understand. Trump is going to appoint another person as of May 2026, Federal Reserve Chairman Jerome Powell's no longer going to be in that seat. And Trump wants the rates to be lower. So they're only saying that the rates will more than likely be lowered just one time as of 2026. But you have to understand that Jerome Powell's only going to be in there for 5 months into 2026, and then a new person will be appointed by Trump. Now, another reason why we're seeing such a surge is the Fannie Mae, the Federal National Mortgage Association, says they no longer require a credit report. They're throwing it out, so we don't need to see a credit report. So here's what Fannie Mae does. Fannie Mae buys mortgages from mortgage lenders. So a mortgage lender will lend you money. No sooner than they lend you money, Fannie Mae's buying that from them. And Fannie Mae buys mortgages in what they call the secondary market, which frees up money from the lenders so they can consistently keep loaning money for people to buy a home. Now, they take those and they basically compile them into what they call mortgage-backed securities, and then people invest in those. So that's why you'll have a servicer of the loan, but you have different investors of which, if there were to be, for an example, a short sale. The purpose of me explaining this to you so you can understand and know and tell anybody and share these videos with you, because you still have to know that your credit score does matter, because it's up to the individual lender. They're going to look at your credit score, and a baseline for that is typically 620 if you're doing FHA conventional, and if you're doing VA, for the most part, it's 580. 2 years on the job, you got to show proof, 2 years of income. They're going to look at your debt, they're going to look at your income, they're going to look at all that information. But I can tell you that they are looking more into things like rent. Can they verify rent? And have you been paying a landlord? And what about your cell phone bill? What about your light bill and your everything? So it's not, now it's not just things that have been reported to your credit bureau, like credit cards, or you're paying on a car note, for example. It's going to be secondary things that can benefit you when it comes to buying a home. Now, Trump has said his goal is to give everybody middle to lower middle class that income limit. What's lower to lower middle class, I don't really know, but I can tell you that he wants to send $2,000 dividend checks. I believe it's per household. Now, a dividend check basically is not considered a stimulus check, but at the end of the day, it's like, why are you just sending the money? And they call it a dividend because it's coming from the tariffs. Now, they've made hundreds of billions of dollars so far in 2025 from tariffs, and Trump's wanting to send money to people. Now, a lot of people are like, Wayne, how's that going to help me buy a house? Well, you have to understand that if your income limit is $110,000 or less, you can get a USDA loan, United States Department of Agriculture, like you see stamped on meat at the grocery store. It's also important to know that these USDA loans are not in major metropolitan cities, but they can be on the outskirts. Like, for example, it may not be in the heart of Davidson County, Nashville, Tennessee, but it may be okay for Robertson or Sumner County. Well, everybody kind of lives in the outskirts, right? That's called the suburbs. Are you with me? But you can't be in the heart of Atlanta, can't be in the heart of Orlando, can't be in the heart of LA. But if you want to drive and live 30, 45 minutes outside of major metropolitan cities, this is a very good loan. And it's basically the same as FHA guidelines. You're always going to have PMI with it. However, it's a really good starter loan because you only need $1,000 out of pocket. You only need money to do an inspection and an appraisal. The seller can pay all of your closing costs. You only need a 620 credit score, 2 years on the job. They pull your debt to income ratio and all that. And a good lender will tell you what you should do if you can't get approved now, what you can do in the future to get approved. Now, you may or may not have heard this, but the median age of a first-time home buyer is 40 years old. Now, a lot of people are like, man, that's crazy, 40 years old. Why is that? Well, part of the reason why is, your guess is as good as mine, but you're probably thinking, well, the interest rates went up and then home prices went up. Well, listen, home prices went up because for 13 years, mortgage interest rates never went over 5.25%. So it allowed homes to be affordable and affordable and affordable, but they kept trickling up because all of that, inflation lags a little bit. And the rate stayed low for too long. I tell everybody that. They should have not left the rates too low for too long, because now you have homes that are worth, $500,000, and everybody's like, there's no way that home is worth that. Well, here's the thing. The market is the one that puts the price on houses. It's not the sellers. It's not the appraisers. It's not the banks. It's the market. When a homeowner puts their home on the market, they have a market analysis done on their home. They have a market analysis done on the price. They can have it appraised, but at the end of the day, the appraiser uses the exact same databases, real estate brokerages and agents. All of that's in the same data. They look at sold properties literally within a 3-mile radius of the subject home they're trying to appraise and give the value for, that is closed within the last 6 months. and they share that data with homeowners, and then homeowners say, well, okay, I can price my house at that. Well, how do you know that? You know that because it's based on previous sales. And those previous sales, listen to me, a home is only worth what a seller's willing to sell it for, is what people say, right? It's really the opposite. A home is only worth what a buyer's willing to pay for it. And when you have buyers buying houses at the price that sellers put their homes on the market sets the price, not the seller. But why is it 40? Why is the first-time home buyer 40? Well, you have to understand credit card debt is higher than it's ever been before in the United States. The average person's credit card debt is $6,700 per person. Like, think about that. That's like $14,000 per household. And then get this, the average used car is $532 a month for a car payment. The average new car is $748 a month. So on top of that, what about medical bills and then groceries and then gas, and then it's all just right? So it's like, man, hell, it takes a seasoned person that's been on their job, that's been there for a while. But you also have to understand too, the same demographic, if you will, are those people that are still on their parents' insurance at 26. I mean, me when I was 21, I'm a grown man. I bought a house when I was 21. But today, they're not so much as in a hurry to be an adult and buy a house. Now, I'm not saying that's necessarily the case in everybody's personal situation, but I can tell you that some people, they're okay not buying a house even if they're 35 years old, and that's okay. The reality is you never have to buy a house because owning a home does come with some responsibility. You're always going to have insurance on it. You're always going to have taxes on it, even if you pay it off. However, you have to understand that if you live in that house 15, 20, 30 years and pay it off, the taxes that you're going to pay at that point in time into the future, plus the insurance, is going to be less than what you pay in rent. Now, don't get me wrong. Real estate is hyper-local, and I don't mean just the value of the home, I mean like taxes. Like, for example, New Jersey is the highest state for property taxes. Most people pay between 12 and 14% in the state of New Jersey on their house, on that value of that house. So you have to understand that it's more expensive in some areas, and I get it. But I'll tell you a quick story. I personally bought my home 32 years ago. It was a brand new house that I bought. I paid $79,500 for the home. That house today is worth $270,000. So you see how you can purchase something and live in it. I can't emphasize enough, there's a lot of people right now, you may be one of those. If so, chime in, ask questions, leave your comments. That's how we all grow and share and gain wisdom in the subject of real estate. There's a lot of people out there that are millionaires and never thought they would be, but they bought one home and didn't sell it for 30 years. Or maybe they bought two homes. You have to understand, if you can invest in real estate. A lot of people say, oh, real estate's not an investment. Well, I'm going to tell you, when you rent, you're paying 100%. You do have shelter. However, they can tell you to move at any time. And when you do move, you have nothing but the clothes on your back and your personal belongings. When you own a home, you gain equity. I'm not trying to talk into anything. I just want you to know that when you buy a home and you stay in it, track record, decades, years have proven it goes up in value. Don't just take my story for an example. Ask anybody that's in their 50s, 60s, 70s, friend, family, coworker, doesn't matter, what they bought their first home for. Ask them that property address, then go to Google and then type in that property address. You'll see Realtor.com, Zillow, they do these estimates on the property value. You'll be shocked to see what that home is worth today compared to what they bought it for 10, 20, 40 years ago. Now look, when you're ready to buy a house, if you have that in you, I think it's great. You're going to build wealth. You're going to build money into the future. It's called equity. It's like a forced savings account. You just pay for where you live and it goes up in value. Here's a prime example of a foreclosure. I've been walking around this house. It's 2,350 square feet. This home was sold 4 years ago for $275,000. Now today it's priced at $92 a square feet. I mean, it has 2 air conditioning units. It's a foreclosure. It's got a 2-car garage, 4 bedrooms, 2.5 baths. This house right now is on the market for $219,900. Now, you may be asking, Wayne, where is that at? Because, man, it's a nice house, right? Well, looks like it may or may not need a roof, and the insides, for the most part, look pretty good. But this house is just north of Lake Pontchartrain, which is New Orleans, Louisiana. And so this house sits about 40 minutes outside of New Orleans. So yes, a house like this, you could actually get a USDA loan. It costs you $1,000 out of pocket to have it inspected and appraised. The seller could pay your closing cost. Not all banks will, but this one possibly could. Pay your closing cost. For the most part, a lot of them do. And then you're out of pocket literally just $1,000. And then 30 days later, you start paying a mortgage payment. Now, before you do all that, it's so important to get approved with the lender. There's a difference between being qualified and being approved. Qualified, you're just talking to somebody on the phone, they take your word for it and what your credit is. Approved is literally being approved. And I always tell people, when in doubt, ask somebody to get you approved, because mortgage lenders right now, you have to understand, the market has been incredibly slow, the slowest it's been in 30 years. Mortgage lenders are chomping at the bit to give loans. They want to give you a loan. They want to show you and help you and show you the process of your credit score may be 610, but they want to show you what you can do. And they have this thing called rapid rescore. So they'll say, hey, if you pay this off and this off and this off, the computer actually does a simulation and shows you what your credit would be if you paid certain things off. So it's really good to always get with a good lender. Listen, if you need an agent, we're here to help. It doesn't matter to me either way. You can go to contactwayne.com, put in your information. Me or one of my team members will reach out to you, call you and talk with you, and we can connect you with a lender. Or you, of course, do it on yourself. Do it on your own. If you're a homeowner and you want to sell your property, go to sellwithwayne.com. And like I mentioned, I've been in the business for 30 years, but I just want people to be educated about real estate. I'm a big believer in whatever you do in your craft, whatever it may be. And I think it's wonderful that we can do this on video now, is you learn something and then you master it and then you teach it, and you have to teach and share with others. So anyway, thank you for watching. I'm Wayne Turner. Share this video, leave me a comment, ask us questions, subscribe to the channel. Until next time, thank you and God bless you.